If you have been following this channel, you know that Alibaba isn't just another stock or ticker to us. It is the largest position in my portfolio and the company we have analyzed, debated and held onto through the volatility of the last 4 years. But next week might be one of the most critical earnings reports we have seen in a long time. The narrative has shifted from "is this company investable" to "how fast can it actually grow?" In this video, I'm going to break down exactly what I'm looking for in the next week's report. We aren't just looking at the revenue bits, we are looking for structural changes in the cloud business and a stabilization in Chinese commerce. I'm also going to discuss why the massive share buybacks we used to love might not be as effective at these current price levels. By the end of this video, we'll have a clear checklist to judge whether the earnings are a buy or a sell signal. If you appreciate deep dive fundamental analysis on the stocks that actually matter, make sure to smash that subscribe button right now so you don't miss our full post earnings review next Tuesday. Before we look forward, we have to understand the baseline. The last earnings report was pivotal because it finally broke the dead money curse. For a long time, the market priced Alibaba as a company in decline, but last quarter proved otherwise. It is what mattered most for investors. First, China commerce finally showed the pulse, growing at 10%. This was crucial because it showed that despite the macroeconomic headwinds in China, Alibaba could still defend its market share against competitors like Pinduoduo or Douyin. But the real star of the show, and the reason the stock began to re-rate, was the Cloud Intelligence Group. We saw growth accelerate from roughly 18% in previous periods to a staggering 26%. This wasn't just luck. This was driven by AI demand and public cloud adoption. Investors stopped looking at Baba as just an e-commerce play and started respecting it as a tech and AI infrastructure play. That 26% growth number told us the turnaround strategy is working. But the big question remains, was that a one-off spike or is it the new normal? So, as a shareholder, what constitutes good news next week? I have set specific benchmarks. If Alibaba hits this, the bullish thesis remains intact. If they miss, we might see a pullback. First, let's talk China commerce, Taobao and Tmall. I am looking for growth to sustain above 10%. Why is this the magic number? Because the market is currently terrified of the Chinese consumer data. If Baba reports 10% or higher revenues, it proves that their ecosystem is sticky enough to withstand a slow economy. It proves they aren't losing customers to Pinduoduo. If this number drops to single digit, let's say 5% or 6%, the bears will come back out screaming that consumption in China is dead. We need double digits here to justify the current valuation. Second, and honestly most importantly, the cloud. I am expecting, or rather I believe the market needs to see, cloud growth accelerate to plus 30%. We saw 26% last time. If they can print a number starting with a 3, it confirms that Alibaba is successfully monetizing AI. In the US, we see Microsoft Azure and Google Cloud posting massive numbers. Baba needs to show that same trajectory in the East. If cloud grows at 30%, the PE multiple of this stock deserves to expand significantly because high growth cloud revenue is worth much more than e-commerce revenue. Third, international digital commerce, AIDC. This is the wild card. It would be nice if international accelerate growth to plus 20%. Lazada and AliExpress have been fighting hard, but they are burning cash to do it. I want to see top line growth over 20%, but I also want to hear management talk about narrowing losses. Growth is great, but profitable growth is better. If we get plus 10% in China, plus 30% in cloud and plus 20% growth internationally, this earnings report will be a home run in my opinion. Now let's address the elephant in the room: share buybacks. For the last 2 to 3 years, the buy thesis for Alibaba heavily relied on the fact that they were buying back billions of dollars of stock at incredibly distressed prices. When the stock was trading at historic lows, every dollar spent on buybacks was essentially buying $2 worth of value for $1. It was the best use of capital imaginable. But the situation has changed. The stock price has recovered significantly. It is no longer dirt cheap. It is now what I would call reasonably priced. So, are buybacks still important? Yes, but the math is different now. When the stock price is higher, the same amount of cash retires fewer shares. The yield on the buyback decreases. As a shareholder, I still want them to reduce the share count, but I am not as obsessed with it as I was when the stock was at $70. At these levels, I actually want to see capital allocation shift slightly. I want to see them pouring money into those cloud data centers to secure that 30% growth we talked about. I want to see them defending their moat. If they announce a massive buyback, I'll be happy. But if they say we are slowing buybacks slightly to aggressively invest in AI infrastructure, I might actually be happier. We have moved from a value trap play to a growth play, and growth requires capital. To wrap this up, next week is about confirmation. We need to confirm that the Chinese consumer is still spending on Taobao. We need to confirm that Alibaba is the undisputed leader in Chinese AI and cloud. My eyes will be glued to that cloud revenue line. If we see 30% growth there, the thesis is stronger than ever. I want to hear from you guys in the comments below. What is your price prediction for Baba after earnings? Are you holding, buying more, or trimming your position before the report comes out? Let me know. If you found value in this video, please subscribe to the channel. I will be doing a full breakdown video the moment the numbers drop, and you don't want to miss that. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.